All right, everybody, welcome back to the channel. Today we're going to learn about credit scores. First, why do you care? The reason you care is because if you ever need a loan from a bank, for example, for a mortgage, a car, student loan, anything that you don't have all the money for upfront and you need a loan from the bank for, that bank is going to check your credit score. Now, the bank is doing this for two reasons. The first is, are they going to give you the loan at all? The second is, what are the terms of that loan going to be? Most importantly, the interest rate. And on a big purchase like a house, a small difference in the interest rate, maybe 1% or even less, could be a difference of hundreds of dollars per month in your mortgage payment. Basically, banks use credit scores as one major factor to figure out how good of a borrower you're going to be. So, are you going to pay on time? Are you going to pay the loan off at all? Are you going to default? And having a good credit score is going to get you those better loan terms because it indicates that you're a better borrower and a better bet for the bank. So where do these credit scores come from? Do they come from the bank? The answer is no. There's actually a company, and you may have heard of credit scores called FICO scores. So FICO is the name of a company that created this credit score formula, and they constantly reinvent it, they refine it, they come out with different versions. And so we'll go over that formula in a minute, but that's where credit scores come from. I will mention that there are some other smaller companies that create credit scores, some competitors to FICO. They're just smaller companies with less of a market share. I think that FICO has something like 90% of the market share for credit scores. So there are other companies, but they're just not as popular. But everything that I say in this video will carry over to those other companies. They just use different formulas. And the third sort of group involved in this situation, aside from the banks and FICO or whatever agency is issuing the credit score, they're the credit reporting agencies. So you'll hear company names like TransUnion, Experian, and Equifax, and those are the three main credit reporting agencies. So really you have three players. The first, you have FICO, or the credit agency that determines the formula. Then you have the credit reporting agencies that actually create the report, that track your credit usage. And then the third player is the bank that uses those products to determine if they're going to give you a loan or not. And by the way, I should also mention that you can get your free credit report at annualcreditreport.com from these three main companies. Now onto the numbers. The credit score range is usually 300 to 850. So we see here on the low end, the lowest score you can get is 300. The highest you can get is 850. And I just said usually your score is this range because there are different FICO models with different ranges, such as 250 to 900. And that's what this score is showing, or the score range is showing. But in all of them, there is a risk level or risk rating associated with each score range, and in all of them, the higher the better. So typically for a loan, to get the best rates, you want to be in one of these top two categories and avoid the others. Now the formula itself, I'm sure it's out there somewhere, but it's hard to get your hands on. It's probably proprietary. But here you can see what the main factors of that formula are. So the biggest factor is your payment history at 35% here. And so this takes into account if you pay on time or miss payments, or if you have any collections against you. The amount that you owe is the next biggest factor in your score. And so this takes into account your credit limits, how much of that limit you're using, and if you have a lot of open accounts. The third biggest score, 15% here, is your length of credit history. So that's how long you've had your credit accounts open. Then tied for the last two places here in terms of importance are the type of credit, which is only worth 10% of your score. So that's, do you have different types of credits, for example, mortgage as opposed to a credit card? And then the fifth factor here, also worth 10%, is new credit opened. And so that's if you've applied for new credit within the last 12 months. So knowing these factors is very important because now you can tailor your behavior depending on what's going to have the biggest impact on your credit score. So for example, you need to understand that missing payments is a big problem because that's weighted at 35%, your payment history here. Whereas opening a new credit card, a new line of credit, that would fall right here into new credit opened, and that's much less of a big deal, much less of a factor on your score. Okay, so I've created here just a very simple, non-exhaustive list to help illustrate what factors increase and decrease your score. And so here's the factor on the left-hand side, and it's ranked by most to least impact on your score. So for example, for payment history, you will increase your score if you pay your bills and loans on time. You will decrease your score if you miss payments or you default on payments. For the amount that you owe, having a low credit utilization will increase your score, and having a high credit utilization will decrease your score. What that means, so credit utilization, so you have a credit limit, for example, on your credit card, and then you have how much you're actually using of that limit. So if you're using a small percentage, let's say that my limit is $10,000, but I'm only using $1,000, that'll be a low utilization. If same limit of 10,000, I'm using 9,000, that's a high utilization. So that's what that means. Length of credit history, so having a long, storied credit history with successful payments. So this part is important. Yeah, you want a long history, but it has to be a successful history, right? That will increase your score. Decreasing your score is if you have no credit or a very short credit history. Types of credit, so having multiple types of credit accounts, for example, a mortgage is different than a credit card account. That will increase your score. If you only have one type of account, that will decrease your score. And finally, new credit opened. So basically, whenever you apply for a loan at a bank, for example, they're going to run your credit score. And so if you have no recent loan applications, if you have no recent loan applications, that will increase your score. If you have multiple credit applications in a year, that decreases your score. Okay, now here's the fun part. You may notice from this list that paradoxically, your score is lowered by having too much credit that you use. So that's high utilization here. Even if you are never late and default in your payments, it still dings you. And also by having too little credit, which is here, no or short credit history. Or let's say that you have a debt, you pay it off successfully, you pay it in full and close the account, like a mortgage maybe. Well, that's going to hurt you here because you close your account and you lose that credit history. And then it also reduces the number of accounts you have. So you get penalized for paying in full and closing the account, but also you get penalized for missing payments or defaulting on payments. Your score even gets lowered whenever you go into a bank here and apply for a loan and the lender checks your credit. So the act of applying for a loan could very well knock you into a worse rate category for that very same loan at another bank.
The reason I'm telling you all this is because I'm playing both sides so that I always come out on top.
So you can see it's sort of a self-sustaining system where you got to be in the middle. You know, they want you to have a high credit limit here, but don't use too much of it. They want you to pay your bills and loans on time, but then don't close the account. So it's just a very confusing system where you have to be like Goldilocks, exactly in the right zone, and you don't necessarily know where that zone is. It's just an absolutely ridiculous system that deserves your contempt. So basically, to max out your score, you want to do these things. You want to have few accounts with big credit limits where you don't use a lot of that limit and pay it off monthly, and then keep those accounts open for many years. Now, to accomplish this, I personally use a credit card with rewards points, and so I'll set all my recurring bills that I can to be paid by this credit card, and then the important part is that you pay it off promptly and in full every single month before that month is over. And then I also, every year or so, apply for a credit limit increase, but then I don't use that extra money. I just use the money that I need to use, and that keeps my utilization low. So in summary, these credit bureaus are doing Satan's work. The whole rating scheme is basically a rigged system where it's very difficult and it takes a long time to build a good credit score, and it's ruined very quickly by a couple of bad decisions or a spat of hard luck or something like that. For example, let's say that you built up a very good score of, say, 780, and you've built up that score over many years of paying on time, of being a responsible borrower, never defaulting, anything like that. And then one day, you have some sort of a medical emergency, maybe you get into a car accident, and you can't pay the bills, and so you go bankrupt. Now that bankruptcy could lower your score by up to 200 points, and it could stay on your credit report for up to 10 years. And so if this seems unfair or unjust to you, well, the problem is the system is not meant for your benefit. It's not meant for you. It's meant for the banks, for the credit agencies, for FICO, right? So it's for all these people that are not you. But this is just one of those things in life where you can complain about it if you want, but the fact is that if you ever need a loan, which pretty much everyone does at some point, you need to understand this information. All right, well, that's it for today. I hope that you learned something new and improved your financial knowledge. Catch you next time.